Good afternoon, everybody. It is time for Managing an Options Portfolio. My name is Brent Moores, and today I want to talk about risk. I want to talk about risk of your whole portfolio and how to hopefully manage that risk. That's a big consideration. We'll get to that in just 1 minute here, but let me just mention a few things before we get too far into this. One, you can follow me or Mike. Mike is helping me on the chat, Mr. Michael Fairborn. Appreciate Mike. He's a good friend and colleague. And you can follow us on Twitter or X, I guess, at Brent Moores CS, at Mike Fairborn CS. Also, as we talk about, we're going to talk about options today. And remember, options do carry a high level of risk and are not suitable for all investors. And information here is for general informational purposes only. It's not an individual recommendation or endorsement of any particular security, strategy, or chart type. Paper money application, which I'll be showing you today, is for educational purposes only. Schwab does not recommend the use of technical analysis as the sole means of investment research. All investing involves risk, including loss of principal. Past performance of any security or strategy does not guarantee future results or success. And we'll be looking at individual securities here, but they're not a recommendation, folks. You know that. If you've been here before, they are just examples here. Glad to see some familiar names in the chat. Appreciate you. And we're glad to have some new faces out there, new names out there too. Glad you're here. And if you're watching on a recording, that is just fine as well. So today specifically, I want to talk to you about a few important things I think that are going to help us with risk management. One of them is delta. One of them is beta weighting a portfolio, talking about your risk. I want to talk to you about how to use the Analyze tab in terms of modeling your whole portfolio in that Analyze tab and how to modify and manage that risk. So there's quite a bit of stuff out there. And just remember, for future webcasts, make sure you subscribe to that Trader Talks channel. Now, let me just kind of ask you a question. I want you to think about risk and risks that you perceive in the market. And things that you may perceive on the market in terms of risk, things like bad earnings, or maybe it's a geopolitical event. Maybe it's market valuations as a whole to your portfolio. People talk about the market being frothy and that being a risk to the portfolio. You may be able to think of a lot of things, but I also want to think about the two biggest market drawdowns that we've had over the past couple decades. One was in 2008. That was the financial crisis of 2008. Realize not many people saw that coming. You know, the whole credit default swap thing, the mortgage-backed security problems that we had. Those were not risks that we perceived. Think about the last one, the most recent biggest drawdown that we had, and that was COVID-19. Not many people saw that as a real threat to their portfolio ahead of time. So my first point is, whatever risks you have in your mind, the next one that may draw down your portfolio isn't something that's even on your radar right now. So we need to be prepared whatever it is. And if you don't see any risks in the market, that's a problem too, as well. So let's just kind of talk about market drawdowns here to talk about what we got. So I have a 1-year chart on the SPX here, and you can see back in July of this past year, we had a pullback of about 9.5% there. Okay, so there's a pullback. That's very typical in a year, by the way. Most years have something akin to a 10% pullback or more sometimes. Let me switch my time frame here on this chart, though. Let's go to a 5-year chart, and let's look at some of the other pullbacks that we've had over the past 5 years. That's a smaller one. Here's a bigger one that we saw. We had that from there to, I'll go to the low. And that was about a 27% pullback. Now, that was not COVID. That was a significant pullback in the market, about 27%. So on a yearly basis, it's very common to see like a 10% pullback. But 27% pullbacks don't happen every year typically. But they're it's certainly within the realm of possibility. And this back here, this was COVID, and this is on the S&P 500, by the way, and this was like 35, it's roughly 35, 37%, something like that, I think. Now, if I went to the NASDAQ, you'd actually see some bigger pullbacks probably on this, but I'm just using the S&P 500 as a whole. But my first point is this. My first point is that pullbacks happen in the market. 10% pullbacks are commonplace, but bigger pullbacks do occur every few years typically. So I want to be aware of that as we're doing that. We need to be prepared on that. Now, before I talk about your overall portfolio risk, however, let's talk about the risk on individual stocks and one way to monitor that. If I look here at my portfolio, one way to monitor it is to look at your delta. And your delta is just a measure of how much this position is likely to move given a $1 move in the underlying stock. If I have 100 shares of stock, as I do on CVX here in this sample portfolio, then my delta is 100. In other words, if the stock drops $1, CVX drops $1, and I have 100 shares, I'm likely to lose about $100 on that transaction. $5 drop, $500. If it goes up $3, probably about a $300 gain on that. That's for the stock. It's easy enough. You look at your quantity, that's your delta. For options, it's a different story because options have a little bit more complex in that regard. If I look at, say, Microsoft here, I've got a spread here on Microsoft, and so the deltas are different. It's not just the number of shares. But just realize here, for stocks, the delta is 100. But this is only partially helpful because, look, if CVX goes up or down a little bit, Delta may go something very different. Delta Airlines, that is, may look at something very different. Pepsi may look something very different. So what we'll commonly do is for our delta is we will beta weight the delta. Beta weight just basically says we're going to take a common measure. That common measure is the S&P 500, or you can change it to something else, but I'm going to use the S&P 500. This common measure, and we're going to say if the S&P 500 goes up $1 or a point, the S&P 500 goes up a point, how much is my portfolio or any position going to be moved by this? Now, of course, we don't know with precision exactly what any individual stock is going to do if the S&P 500 goes up $1, but it gives us an idea. And for this portfolio right here, my total here, I have a total column right here. I'm going to round and just say it's about $9, okay? So that means if the S&P 500 goes up a point, my portfolio is probably going to gain approximately, very roughly $9. If it goes down a point, I'm probably going to lose about $9. But the thing is, with the S&P 500, a point move is very, very little. The S&P 500 right now is roughly $5,900. Okay, $5,900. So that means a 1% move, and a 1% move is a significant move, but nothing super earth-shaking. It's not like headline news on the nightly news or anything if we had a 1% move. A $59 would be a 1% move. So let's do the math on this. 1% move down, $59, I have $9 delta. If I take $9 delta times $59, that means a 1% move in my portfolio up or down is going to equal approximately approximately $530. That's up or down. Okay, is that making sense? Up or down, 1% move. Now, $530 may not seem like that much, or maybe that does seem like a lot. Keep in mind, that's a 1% move. What about a 10% move? Well, 10% move, I'm just going to add a zero onto that, about $5,300. Now, I don't want to express too much precision on this number because delta changes. Delta isn't consistent. It moves as the market moves, it moves as time moves. But that's what the kind of moves that we're talking about. And you need to ask yourself, if my portfolio took a 10% drawdown, for example, am I comfortable with that? Not that we want that, but are you comfortable with what the risk is that it shows you? In this specific portfolio, it's giving me that risk. You'll have to measure that out in your own portfolio. You can just check beta weighting, put in SPX. You can put in something else if you like, and you can see what that is. And you can ask yourself, am I comfortable with that kind of move? Not that we want it to be, but is it permissible in my portfolio? Because if the answer is it's not permissible, that's too much, my portfolio can't stand that, then you need to maybe take some measures to adjust your portfolio. Now, let me tell you something. This is not a super high delta given the positions I have, but I want to show you something. This is something I did in a webcast the other day. If I look at Goldman Sachs, I actually have 100 shares of Goldman Sachs. I also have a strategy called a short, I have a short synthetic on this, which is reducing my delta here. In other words, look at this. Here's my stock. Here's my delta on my stock. Look at my options. I have a -5 delta there, a -5.8 delta there. I have roughly 11 negative deltas in here. If I take those off, let's look what happens to my overall delta. Remember, my overall delta is close to 9 right now. But what I'm going to do is I'm going to get rid of some of these positions here. So I'm going to, I want to get it filled, so I'm just going to throw in a market order. Just get rid of that. And I'm going to do the same thing here for the put. Let me create that closing order. I'm going to get out of this put here. And I want you to see what happens to my portfolio. Now, let's look at that delta. That overall delta just changed. My delta is now 19, almost 20. Okay. And let me look at one other. Okay. Here's Bank of New York Mellon. I've got 100 shares total on Bank of New York Mellon. I have the same thing, similar situation here. And I'm going to get rid of these options on this. And that is going to, so in other words, your option trades, anything you do in your account is going to affect this overall delta. Now, my overall delta is now just a little bit over 20. I could do that same calculation I did before. Remember, about a $60, $59 move represents a $1 move in my portfolio. That's a 1% move in the market. 59 times my new delta of 20 means my risk would be about $1,100, almost $1,200 down. And I could do the similar thing to the rest of my positions. But if you want to adjust your portfolio, there's different choices that you can make. The first thing I would say, though, is know your portfolio risk. And you can do that by looking at delta, beta weighting your portfolio, and doing it that way. But the first thing you may consider is just taking off positions. If I deem my delta to be too high and I want to reduce that delta, look, if I were just to sell Goldman Sachs here, that would cut my delta in half or more. All right? So reevaluating your positions and deciding what to get rid of may be the first course of action. Now, I want to take you to the next step here. I want to show you that you can model this if you want on the Analyze tab on the risk profile page. Let me pull up SPX here. Here's SPX. Now, you guys, I think a lot of you have seen this, this risk profile page, but I think a lot of you maybe have not used instead of using single symbol here at the bottom, you can change that to portfolio beta weighted. Here's my portfolio, my beta weighted portfolio here. And this graphs it out. Now, today's the 8th, so the purple line is what we're going to look at here on this. And I'm going to hide my simulations. There we go. So both lines are going to be the same here on this. Here's the current value of that SPX. This is a graph that is going to show me profit or loss. This y-axis right up here, this is the y-axis. This is a $30,000 gain, $20,000 gain, $10,000. Here's my break-even point. Here's a $10,000 loss. Here's the current price on my current price of the SPX. And if the SPX goes up 10%, this line represents a 10% increase in that SPX. This line right here, this dashed line, represents a 10% drop in that SPX. Okay, and you can see that right down here on your price slices as well. So what this is saying is, here's my line. The higher the SPX goes, the more money I'm making in my portfolio. The lower the SPX goes, the less money, or the more I'm losing in my portfolio. This is kind of where I'm at right now, this spot right here. But you can see this model down. How much is it moving? Well, it's moving by the amount of the delta. Now, earlier I mentioned the delta can change. It's not always, I said it's 20 right now. Well, notice if we're down, if the SPX goes down 10%, our delta is about 15. Or if it goes up about 10%, it's about 15. This will change depending on what kinds of trades you have in your portfolio. If I had, for example, a portfolio full of just long calls, then if the price went up, my delta would be higher and higher, and if my price went down, my delta would be lower and lower, and vice versa if I just had short calls on that. Okay? Now, so this is the basic way to look at this in terms of a graphical form. You don't have to use this graph right here, but if you'd like to use the graph, it is available for you. Now, here's the thing. There's a question in the chat. What's this gray band right here? This gray band is basically just saying between now and whatever date I have up here, and right now I have on January 11th, what's a standard deviation, about 68% move in my portfolio? That would be that's what this represents right there. Okay? If I change this date out, then this would expand out because there's more time for this to, more time for the index to stray more to the upside or the downside there. Okay? So we do have past sessions on using the risk profile tool if you've never used this, but I wanted to give you like a little introduction to it, and especially even for those of you who already are familiar with this, to realize you can use this as a a function as a graphing device to show the risk or potential reward for your whole portfolio here. Now, here's what I want to do. I want to take it to the next level here. I'm just going to shrink this down and I'm going to show all. And as you look at these, I do have some simulations in here already. And I'm just going to get rid of some of those just so we can kind of start with a clean slate here on this. So the ones that have an X on it, I can just get rid of. These are all just simulated trades I've looked at over time. And, but I want to show everything. So I'm going to get rid of those simulations. And now what I'm left with is just the stuff that's in my current portfolio. Okay, this is a current paper money portfolio, if you will. This is what this portfolio looks like right now. But realize, if I adjust things, I can model and see how my portfolio is going to be affected by this. So for example, let's say I took off my Apple trade here. I have a long call on Apple. Okay, I have a long call on Apple. It's a leap, actually. This is a long, it doesn't expire for a while. But if I uncheck this, notice there's a check mark next to this. If I uncheck this, this whole thing is going to change. In fact, look, you can see it graphically, but you can also look right here. Look at the middle line here. There's 3 rows, top row, middle row, bottom row. Look at the middle row. That's 0 offset. That's the current price. Here's my current delta. Here's my current PL open, just below 12,000. But look, if I take off that Apple trade, notice things have changed. My delta, instead of 20, is now about 18. My current PL open has changed, but it doesn't just affect that. It affects my delta up here. It affects my delta down here as well. So I can see what removing any particular trade in my portfolio is going to do to affect my overall risk or potential reward in the trade. And just a reminder, these measures aren't exact. We don't know exactly what's going to happen going forward in terms of like delta measures or profit loss open measures if the market moves, but that's the first thing. Now, here's another thing. In addition to taking off positions, I can look to add positions on there. So for example, let's think about some different kinds of positions I may want to add. Let's say I add on a long call. In terms of delta, what's that going to do? Well, throwing in a long call, that's going to add positive delta to that. So if I want to increase my delta, I can add on a long call. If I do a long put, what's it going to do to my delta? Well, it's going to add negative delta onto that. And I'm focusing more on delta, but keep in mind, we could consider theta as well. If I throw on a long call or a long put, that's going to subtract theta if I have positive theta, or it's going to add negative theta onto my portfolio. Now, these tend to be very impactful to my Greeks. But keep in mind, I could do, say, a long stock. Well, if I add on long stock, that's going to add positive delta. Okay. What's it going to do to theta? Long stock isn't going to do anything to theta. Long stock does not have any time decay element to it. So it's not going to affect that. What about, say, a short call vertical? What's that going to do to my delta? Well, that's a bearish trade. That's going to reduce my delta, but not as much as just like a long put would, because a short call vertical, we have a long call and a short call, and they partially offset each other. In fact, to a large extent, offset each other. So the effect is going to be more minor if I add on a spread trade. Same thing if I do, say, a short put vertical. That'll give me some positive delta. And if these are out of the money, then my theta, it'll add some positive theta. Well, maybe I want some more positive theta. In general, in this webcast, going forward, we're going to try and say, we kind of like those positive theta trades very often. Now, there's pros and cons to different types of trades, no doubt. But if we want to increase positive theta, which may be a goal for some of you, then you may consider some of these trades. But just remember, these spread trades are going to, they don't move it as much as just like a single option. So I could just do a short put. A short put is going to give me some positive delta, and it's going to give me some positive theta as well, more so than that short put vertical. All right. Now, I'm not going to go through an exhaustive list of all trades here. Let me just do maybe one other here. A calendar, or well, maybe we'll do a couple others, an iron condor. What do calendars and iron condors do to your delta? Probably not much, to be honest. Initially, they're probably going to give you not much of a change on deltas. As the stock moves, that delta will move. And that's true for all of these. The delta will change as the underlying stock moves. Our theta on both of those would be positive. Okay? All right. So that, just realize I can add individual stock trades on here to affect my overall stock or option trades on individual positions to affect my overall portfolio. But there's another thing. Maybe you want to affect your overall portfolio in a bigger way and not these like little piecemeal type approaches of, adding on a Disney trade or something like that. Can you do it in a larger manner? And the answer is yes. One approach is to use index options. Now, we actually have a whole webcast on index options. It actually occurred right before this webcast, and it's going to each week. And most weeks I'm not going to be focusing on index options, but I do want to mention them as a potential to say, as a way to do kind of a wholesale change to a portfolio instead of these like kind of little piecemeal approaches. Okay, so let's look at doing index options. Now, I'm going to start with this SPX. All right, let's start with the SPX. Now, just in the chat, Wiley said, what about synthetics? You can use synthetics. In fact, the first thing I showed you today was I used a synthetic to hedge that Goldman Sachs position. You remember that? That's why I did it. It was completely a hedge. I did that in a class, I don't remember, a week or so ago. And it actually helped out because Goldman Sachs had pulled back and it benefited me during that duration. So you can use a synthetic. A short synthetic is going to add negative delta to your portfolio. And typically the theta effect is going to be very minimal. A long synthetic, positive delta to your portfolio. Again, the theta effect is going to be very minimal in that case. So yeah, I think that's fair. But let's look at this. I could do an index option on the S&P 500. So how would that affect it? Well, one thing we can do on this is we can model and see how it would affect the trade. So I'm going to add a simulated trade. And what I'm going to do is I'm going to go out on the SPX. I'm going to go out about a month. Okay. So I'm going to go to February 7th here on this. Here's February 7th. And I'm just going to go and I'm going to look at, let me get some more strikes here. I'm going to go out to about a 30 delta here on there. So 57.50. I'm just going to jot that down so I don't forget it. 57.50. And I'm going to buy a put here on this. 30 delta. So how's that going to affect this trade? So I just added a simulated trade in here. And now look what happened to my delta. Okay. So let me go here and just to kind of highlight it for you. Did you see how the delta changed? Once I had a positive delta. I think it was positive 17 or something like that. Delta. I've just switched my whole portfolio here on this. In fact, let me do this. Let me go and go to SPX. And I'm just going to uncheck this for a sec. Yeah, my delta was about 20 right there. And if I were to add this trade on, my delta actually becomes a negative 10. Okay. So that certainly changes the characteristic of my portfolio. In fact, what I can do is I can, let me get rid of that. I can go to my risk profile and look at that trade. Before, what did it look like? It looked like this, right? It looked like that. Look what that line looks like right now. So you can see how much that one trade is affecting it. In fact, that trade is going beyond a hedge. That's not just like trying to protect a little bit. This is like totally changing the characteristic of my portfolio. So this may be a little bit overkill. I went from bullish portfolio to bearish portfolio. What if, however, I don't want to do a full, change the portfolio from bullish to bearish? I just want to make it a little bit less bullish here. Can I do that? The answer is yes. So obviously there's other indexes out there I can use, number one. Some traders, and it's not something I can talk about in this class much, but let me just mention this. Some traders will look at things like ETFs. We have a class on ETFs, folks. Classes at 4 o'clock Eastern time on Mondays on trading ETFs. Are there other possible things that track the S&P 500 like the SPX that maybe have less of an impact on your portfolio? Yes, there certainly are. And some of those may be ETFs that you could use to give less impact. Another way to do it is you could look at things like, instead of the SPX, you could look at the XSP. Okay, XSP. Now look at the SPX price, 58.82. Look at the XSP. Instead of 58.82, it's 588.2. In other words, the XSP is an index option. It's not an ETF. This is an index option that is one-tenth the price of the SPX. Therefore, the portfolio effects are going to be approximately one-tenth. So if that SPX was like using a sledgehammer to nail a little brad nail into a wall to hang a picture, maybe this is a more appropriate type measure for that. Now, that's not a recommendation for you to go out and trade this. I'm just showing you there are alternatives here for you in case you're worried about using too much. So let's kind of model that here on this just to show you. And then after that, we'll probably need to wrap up. So XSP, I'm going to go out, same date. I'm going to go at February 7th. And I'm going to go to 575. This is the equivalent strike price right here. I'm going to add in there a position, and I'm going to then go to my risk profile. I'm going to beta weight this back to the SPX like we had before. Let me just uncheck that just to refresh ourselves. Oops. Refresh ourselves where we were. This is the portfolio that we had. Okay. This is the portfolio that we had. We had a delta of 20. Okay, it's going to move around, but we're just going to kind of remember delta of 20 and delta of about 15 and about 15 if we go up 10% or down 10%. Okay. In fact, I'm going to jot that down real quick. 20, 15, 15. I'm just rounding. And my theta, here's my theta, about minus 24. We'll just look at the current theta, minus 24. Okay. 24.3. Now, let me get rid of that and go here. And remember, if I put on the SPX, my delta, instead of positive 20 is negative 10. We said that was overkill. My theta became minus 174. That's a big, big change. That's like 10 times the negative theta I had before on that. Look at the SP. Look what happens if I do that the XSP there on this. My delta is now 17. Okay, 17. Our delta went from 20 down to 17. That is a much more manageable amount there. Now, could I do, if I said, well, 3 points is, I want a little bit more than that. I don't want the whole sledgehammer thing, but I want something a little more than that. Could I do 2 contracts? I could do 2 contracts. Could I change which strike price I do? Yeah, that would affect it a little bit too. I went to about a 30 delta on this. I could do something that's maybe a 40 delta. That would affect it a little bit more too. Okay. Now, if you wanted to, let's say you had some ETF in mind or something you wanted to use, you would do the same thing here just to double check how it affects your portfolio. But we're looking at index options here today. Now, there's just one other thing I want to mention. Just make sure when you're looking at these, maybe you're looking at some other instrument that you don't know, some other index option or something that you're not even haven't used before. Double check and see what kind of spread you have between your bid price and your ask price. Let me go to that XSP here for XSP here. And let's look at the contract. We were doing the 575 put contract. So notice it's a moving target. So there's about a 20-cent difference between my bid price and my ask price on these. Okay. There's about a 20-cent difference there. 20 cents on a $5 and where was I? $5.80 option is not that much. That represents less than 5% difference between the bid price and the ask price. That's good. Generally, I say let's get it less than 10% difference on those. Okay, so that's not terrible there. But double check those on whatever contract you're doing. We don't want them too wide. Now, Aaliyah asked a great question. Is your goal to get the highest delta possible? That's a good question, Aaliyah. And the answer is no, that's not the goal. Because you may want to, at times, have a higher delta. But remember, and what would be the benefit of a higher delta? The benefit of a higher delta in your portfolio means if the market goes up, you make more and more money. But that would be ignoring the whole risk side of the equation. And that's our whole goal today, is to try and manage risk. So you may want to deliberately lower that delta. Now, can that work against you? Yes, it can. If the market just keeps going up and up, if you knew for sure the market were going up and up, then you'd want as high a delta as possible. But the problem is you don't know the market. And even if you think you know the market's just going to go up and up, you have too much confidence. Nobody knows. We don't know what the market's going to do. And so we want to keep our delta at a manageable level. Remember when we started out today, we talked about how risks in the market and market pullbacks and a 10% pullback and that 35% or so pullback we saw back in 2020, that's what we're trying to prepare for. Okay? That is what we're trying to prepare for. That beta weighting symbol should be available both on paper money and on the real platform there. So, folks, I'm not here to prescribe to you exactly what your delta should be or what your risk should be in your portfolio. But what I want you to do is I want you to, number one, think about it, and number two, have the tools in place for you to be able to measure that risk. When you have the tools, you're empowered to make better decisions, and that's our whole goal here. Now, there's other things we can do to make better decisions, and one is to keep educating yourself. There's a webcast later today called Market and Sector Analysis. It's at 3 o'clock Eastern time today. I want you to check that out. That's a great webcast. Mike Fairborn teaches that webcast. He's a wonderful instructor, and I think you'll benefit if you watch that webcast. But we have a whole slew of webcasts, folks. I don't know how many we have in a week, over 30, I think, during the week. And so as you check those out, you'll be great. Just check out the Trader Talks channel on YouTube there. All right, everybody. Coming up next, we've got trading price patterns. Check that one out too. Appreciate you, Mike, for helping out in the chat. Appreciate you for joining us. Everybody have a wonderful rest of the week, and we'll see you all same time next week. Bye-bye, everybody.